From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. It's Friday, January 7th, 2022, the first Macrocast of 2022. And it's a jobs day, big jobs day Macrocast. Got Tony Fratto here, Brendan Walsh and John Fagan, Markets Policy Partners, Matt McDonald from Hamilton Place Strategies, as he is here on every single jobs day. Matt, you want to run us through the numbers? I think the report surprised some people this morning.
Yeah, sure. I guess this is technically the last jobs data of last year, though the first day of this year that we're talking about it. The headline employment number was up 199,000. The unemployment rate was down pretty significantly to 3.9%. Worth noting, the unemployment rate pre-COVID, so I guess February 2020 was 3.5%. Mm-hmm. So we're not quite all the way there, but job market continues to heal. The 199 is generally considered a miss off the estimate. The estimate was for 422,000 about. But I would it seems like a bit of a mixed bag report, but it's worth. I mean, there's a lot of caveats that go along with this, right? So this was, the surveys in the field the week of the 12th. So this is generally pre this latest COVID spike. Hourly earnings continue their march upward. That was year over year, 4.7% increase. There were notable revisions to kind of, I guess it would be November and October, up around 141,000, which, for all the data in 2021, and there's typically some revisions that go along with it, but we averaged over 500,000 jobs created per month in 2021. So that's a pretty robust number. The labor force participation rate is the same at 61.9. That's been kind of trending up over the year, but still below the pre-COVID values. So a little bit of a miss on the headline number, but the unemployment rate is certainly robust. I think there's given that it's kind of the before this latest spike, it's a little bit of a open question of how to interpret some of this stuff. My personal suspicion is that I don't think with the latest spike that's materially changing a lot of the kind of trends or structure in employment. I don't think it's going to be a big hit. The unemployment rate is robust and low, and I would be surprised if this at least changes any minds in the Fed in terms of what the direction was that they were indicating, which is kind of the big enchilada on this whole thing. So
did you have participation rate handy?
The labor force participation rate is 61.9%. So, that is up. It was in December of 2020, it was 61.5%, but it's still below where we were pre-COVID. So you had, and it's worth noting, the labor force numbers were up, 100,000 plus. You just had, you had that, the non-institutional population, which is the denominator in that figure, went up as well. So I don't think, we saw this after the financial crisis too, is that it's a little bit, I think it's going to take a little while to kind of figure out some of the participation rate implications of COVID, because you had this over the last crisis too, where you get kind of an extended period like this, and that coincides with the retirements of the baby boomers. So it can be a little difficult to pull apart what is the labor force dynamic versus what is just the demographic component of the change in labor force. And you add, this has been a weird one where you had, obviously, you had a pandemic that disproportionately impacted old people. You had like spikes in equities where if someone's debating when they're going to retire and their investments are really up, that may nudge them forward a little bit. It wouldn't surprise me if we're pulling forward some retirements from the coming couple of years, and then maybe we have like a lull for a couple of years or something like that. But that will impact the rate of kind of recuperation of the labor force participation rate.
Yeah, the wage data, which has been very strong, we're up to 4.7% on a yearly basis for weekly average hourly earnings. But like that, they also have a bit of a collection of data issue when you have, especially low wage workers going in and out of it. The denominator can get too heavy, skewed too.
There's a big composition effect across a lot of these pieces.
Yeah. So look, I mean, when I look at all the numbers, all the job related numbers out there, so, wages, the wage increases are a signal of strength. JOLTS is a signal of strength.
Yeah, definitely.
The household survey was strong. Weekly unemployment claims were strong. The number of people receiving unemployment has fallen significantly. It's really the employment survey, which is the outlier in terms of not being particularly strong. And it's also the most modeled number also. And I just think there's so much noise in there. I mean, Betsy Stevenson said something this morning about, not accounting for gig workers. And I'm sure that's true. And, there are probably other reasons out there. I just take a step back and, look at this like you're looking at an impressionist painting, and take a couple steps back and look at it. And actually, the employment situation is pretty good. I mean, there's strength. People who want a job are finding opportunity to get a job, with the exception of a couple sectors, which should be no surprise, I don't think. I mean, leisure and hospitality. If you look at the pre-COVID numbers, we're down about 1.2 million on leisure and hospitality. We're down 927,000 in government, and we're down 761,000 in education and health services, which I suspect that's more education than health services, but maybe it's health services too, if you throw in doctors and dentist offices, which we know a lot of them went out of business, and because people just went. That's where a lot of retirements came from, where people with means decided to retire, and dental assistants found themselves out of work. There was there's a lot of stuff in there that's concentrated in those three sectors. That's a huge part of the undershoot on job, on the workforce right now. And I just look at it, and I think it's actually pretty good. I mean, there's it's going in the right direction. There's going to be noise in the employment survey, and overall, we're back. We're saying the same things that we've been saying for 2 years now, which is we've got to see through COVID.
I don't even know. I mean, to that point, I don't even know that I think that's true for very directly impacted sectors like, hospitality and that sort of thing. But I don't think that the most recent spike, which is huge, is going to have the same labor force impact that any of the prior spikes did. I think it's baked in. I think that employers and employees kind of have a sense of whatever that risk calibration may be. And I also think that, knock on wood, and everybody's hoping, but I think that there's a general feeling of kind of like, well, geez, everybody's getting it now. So this really is going to be in a month, it's really going to subside, and people will have both a different risk appetite, and the spread will just be materially less.
Yeah. You've seen a lot of, retail businesses have to close for a few days because all their employees had it, but they waited
not doing layoffs
and reopened. There was no layoffs. Yeah.
Right.
You just had to wait, a week. And then you're back at it. So this time I think is very, very different.
Yeah, I think
the Bloomberg economist is predicting that January could be negative. I mean, it could be, but I'm not sure that makes sense, actually.
I don't know why we would expect them to be any more accurate on downside than they've been on the upside on on some of these guesses.
Right, exactly.
Guesses. Yeah, I don't think people. A lot of the people who are willing to go out with their estimates. I said on Twitter this morning they should put a confidence estimate on there too, because I'd like to know how confident they are in some of these estimates. Because
I know. Well, also, I mean,
it's all storytelling.
And the question is, were you employed the week of the 15th? So if that week hasn't happened yet, the way the world changes from week to week, why don't you wait a week to have a little more confidence?
Yeah, look, you guys all have kids in school, so you know how schools are struggling with it. And guess what? Like I think we're gonna have weather factors and some of these things too as we go forward too. It's gonna be like a noisy winter because of weather and Omicron and in certain sectors like schools. But like to Matt's point, you don't get a sense that even in the hospitality industries that anybody is talking about shutting down or airlines are still going to be flying, resorts are going to be open, Disney is operating, the movie theaters are operating. They all have a lot, some room to run to get back to pre-COVID levels, but they're not talking about going in the opposite direction at all.
No, and actually now the data that we're getting from Omicron, it is showing. So Los Angeles released data where they're now breaking it out. So 2/3 of the COVID patients are there for other reasons, and they found out that they had COVID because they got tested at the hospital. Yeah. And also, if you're vaccinated and you don't really have a comorbidity, this one actually, knock on wood, isn't really any particularly worse than just the normal flu. We're not seeing a spike in ICU admittance and especially mortality,
except among the unvaccinated.
Among the unvaccinated.
Once again, like. At a certain point, you can only say everyone needs to be vaccinated and boosted. We're going to say it every day. We're going to say it every day until we get substantially higher numbers. But that's really the only differentiator, or maybe the Pfizer therapeutic drug, is more broadly available to prevent hospitalizations and deaths also.
This is maybe a dumb point, but like psychologically in the previous waves, it seemed as though, where we live, the idea of getting COVID was still there. I wouldn't say that there was a stigma, but it was like,
didn't want it,
like,
though.
You got unlucky, there was something that was unlucky and something went wrong and you ended up getting it. Now everybody's
and you were honestly more worried about having to tell everybody in your circle that you have it than you were of dying of it. Yeah.
That's right. It was psychologically taxing. You didn't want to be that person that has to say, hey, I came to the party and, I tested positive 2 days later and everyone was like, oh, gosh. Yeah. Now I think like Omicron's really broken the ice on that. And it's no longer like, it's so infectious. It's, and as to the point that you guys made, like everybody's got it at this point. We're now like in a position where, it's just, this is, I think that the people that are saying that, on a public health basis, turning this into the flu is eventually where we're going. And this is at least, in terms of the psychological aspect of the way we think about COVID and getting COVID and what it means to get COVID, Omicron is a very normalizing and sort of leveling kind of experience.
It is interesting actually, because this has come up in some board work that I do, is that we talk about this like transitioning to an endemic disease where it's just like the flu and you just manage it and you get your yearly shot or whatever. But there is actually a specific designation, I think at the CDC, of whether endemic diseases are not required to be reported, whereas COVID is. And that's actually, that will be, given the track record of kind of like the public health apparatus, I am expecting, I'm not tuning in eagerly to see when that specific designation happens. But just because the disease functionally becomes endemic does not actually mean for businesses, for schools, for other institutions that they are allowed to act like it is endemic and just kind of like go about their business. So it feels like there's this aspect of like, okay, we're kind of witnessing the end of the pandemic, but not the end of COVID. And we're not, that still is, there's still some like technical aspects of all this that are just it's gonna hang around for a while, because because I don't think it's gonna die out. And then you get this aspect of like, there are particular aspects of an endemic virus that takes some like bureaucratic finessing that it doesn't feel like they're ready for that.
I'd love to see endemic or not. I like the, you guys have all used the at-home tests, right? Have you?
I haven't.
We just used our first one the other day. It was pretty easy.
Great. Yeah, they're great. They're easy. They're 15 minutes. You know whether you have pretty good idea whether you have COVID or not. The positives are usually pretty strong. And I'd like to see lots of other things, including the flu. It should be like maybe standard for people to have at-home tests. Like, I think I have the flu. You go take your test. If you can get the cost of a test down to the cost of a cup of coffee, it's kind of worth it to know whether you actually have the flu or not.
Yeah, because the flu can really blow up an office.
Tony, you could build a machine that has like all these tests with just a drop of blood. It'll be amazing.
Well, the new military vaccine is supposed to be the silver bullet, and it's supposed to include also the flu vaccine in it. So we'll see if that one comes to fruition.
Well, I could imagine where they have a vaccine that's that's a multi-virus vaccine. Yeah. I know they're working on it. But regardless, I think you could probably do home. Like I like the idea of the home test, adoption of home testing for all kinds of things. I think it would be really, really terrific, and probably limit the spread of all kinds of things. And because before there are a lot of people, for example, who think they have strep throat, and they go into hospitals and go to their doctors and they demand an antibiotic protocol for strep throat, and they don't have strep throat, they have a sore throat. And strep throat is a different thing. It actually is is a virus. I'd love to see like a test of that and reduce the amount of prescription of antibiotics, which are resulting in the creation of superbugs. There are probably like lots of reasons, lots of ways you can get a whole lot more efficient if a large segment of the population was doing a good job of using home testing. I think it'd be a pretty good shift in both the economy and in health outcomes.
Yeah, so many people now use Google to identify what they have, and then they go into the office and demand it. This cuts them out from having to go into the office to demand it. They can just do it on their own. Yeah.
Hey, John, are markets making any sense of this jobs report?
So the Treasury market really kind of had its preemptive freak out late last year, early this year. And it was very much based on, to a great degree, based on the Fed's pivot. The Fed minutes that came out earlier this week were very hawkish. We're going to talk a little bit more about that later in the show. But the upside that we'd seen in yield sort of inoculated the Treasury market against a big reaction to the upside if there were going to be a big surprise. But really, and this is obviously a pretty mixed bag kind of number. But a rally really isn't in the cards, because the Fed has basically told us that they're not particularly focused on full employment anymore, and they're focused on inflation fighting. They've really, committed. I think one might say overcommitted to this remains to be seen, but to the inflation pivot that's underway here. And so this number really doesn't matter that much. You get a sense that the Fed is always going to focus on things that are inflationary, like the average hourly earnings, and those are really high. And so there's nothing in this report that's really going to change Fed Chair Powell's mind, or the mind of the collective thoughts of the committee here when it comes to their estimates on rate hikes and tightening.
John, so, what's the theory on the amount of time that it takes for Fed policy to work through the economy? What is that, 18 months or something? What's that?
Well,
concept?
Right. I mean, in terms of like translation from the first rate hike, I think right now, one of the things that would be great to hear from Fed officials is there's like this kind of disconnect in their rhetoric right now about how their policy is going to feed through into inflation fighting, because they've said they trashed transitory, and they were making a very strong intellectual case for transitory, which they threw in the garbage can late last year. And now they haven't really explained why they think their withdrawal of accommodation and pivot to rate hikes is really the right prescription for the kind of inflation that we're seeing, which is really by any measure very substantially based on supply chain disruptions. And yes, demand is strong. Yes, the labor market is strong. But, is this, and so even if you said, well, there's an 18-month lag between a rate hike and its actual feed through to the economy, this kind of economic and inflationary circumstance is just so unprecedented that it's really hard to even make that case. I think the other thing to say is that the Fed's policy has very explicitly worked through financial markets. And so they have accomplished a lot of easing by monetary conditions feeding through into higher asset prices, reflation of asset pricing. And when the Fed pivots into tightening mode, those asset prices suffer reflation in reverse. And so you get a very immediate impact and a front-loaded and forward-looking impact on the reflationary signifiers in financial markets. And we have begun to see that. So, there's a chance that this reflation in reverse, which is amplified by financial market price action, eventually swamps, inflation concerns, real economy inflation concerns as we go forward.
HPS is hiring full-time paid summer interns. We're looking for undergraduate juniors interested in public policy, economics, and communications to support our dynamic public affairs client teams. Interns have immediate client exposure and opportunities for professional development while working in a fun, fast-paced, and challenging environment. Learn more and apply by Sunday, January 23rd at hamiltonplacestrategies.com/careers.
Well, let's dive into that, John, in terms of what the Fed is saying. I mean, Matt's question, it puts you on whether you're talking about the real actions of the FOMC and what they're really doing with running off the balance sheet and rate targeting, but also there's this is like this is a hot debate, right, of just whether they're signaling, because their signaling is immediate and the actions are over time, and you can argue, there are lots of people do over what is the greater impact.
I just thinking through today's jobs numbers. I just view this jobs report. It feels very backward looking for whatever reason. It just feels like we're at full employment, and is it 200 or is it 300? My bet is it gets revised up, but it's kind of, pushing, you're getting to the point where pushing more on the accelerator or letting the accelerator run or whatever just isn't going to get the same juice as before. And in a context of, increased prices, the pain is going to feel more and more as we go forward. And this just feels like, obviously with the Fed announcement, with this jobs report and now unemployment below 4%, this just feels like the pivot moment where the emphasis is changing.
Point. You have to keep in mind where we are coming from. It's very, 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 very accommodative policy. So even if inflation wasn't going up, with the unemployment rate at 3.9%, it might be good to go to very, very accommodative instead of 7 very berries,
Yeah, sure.
Yeah. Look, I think, but I just don't think as much support is actually necessary for this economy. In all honesty, there's still shifting going on in the economy, but I just to me, I just really look at the leisure and hospitality numbers. And I think you're going to see the crest of Omicron. I think we're going to come back to a summer. Now,
the models are picking January 9th as the peak for Omicron now in the United States. Yeah.
Right. So that's going to come off. I think we're going to have a normal baseball season. I think we're going to have a normal summer vacation season.
Labor relations might not let that happen, but I think Omicron or COVID will.
setting that aside, assuming players and owners can work out their share of profits. But my point is though that like it's going to crest. We've seen it in South Africa already. It's going to crest. It's going to come down. It's going to happen pretty quickly. We already know that in warmer weather, as people spend more time outside, that it's going to come back. Now we don't know what we don't know, which is there some other mutant coronavirus lurking that is going to pop up again at the end of summer and scare the shit out of us into fall and winter again. But even if that happens, I think we have a lot more confidence if that would happen, variations in the coronavirus, that the way that we kind of know what we're going to do to try to prevent the spread of it. We know that the vaccine makers and the testers have learned a lot on how to create the tests, how to create the vaccines, how to distribute them, how to encourage people to use them. Like all those tools are available, like they have not been available so much in the past. And so each one you would suspect would have a smaller, economic impact. I think like inflation's going to come down, growth is going to come back. I'm going to look at those hospitality and jobs numbers. I see them coming back. And you're going to have a pretty good economy. I don't know if I'm going to say Goldilocks, but I think it's going to be looking at a pretty good economy.
Yeah, and I think what the thing that really freaks out the markets right now, and not that the markets are really freaking out at this point, is that the Fed is implying that they're so focused on inflation now that even if the rosy economic scenario doesn't play out, they're hiking anyway. And they're going to keep hiking until inflation comes down. And they're not really thinking that hard about full employment anymore. They're not, they kind of pay lip service to the economy looks great. It's fantastic. We are going to have a big fiscal drag. There's a slowdown in China. Their high energy prices are, one would say not necessarily inflationary, but actually sort of sapping of consumer vitality and so forth. So there are reasons why Wall Street is not concerned about growth in 2022, but has some question marks around the growth outlook in 2022. And the fact that the Fed is basically said, look, inflation's way too high. It's been too high for too long. And we're going to have to, keep tightening the screws on policy until it comes down. That creates a scenario where you can have the Fed tightening into economic weakness. And that is a bad formulation for risk assets. And it's something that, we can see that in the continued flattening of the Treasury yield curve. So it's something that Wall Street is worried about. They're not, it's not necessarily, red flashing, dashboard lights at this point and warning klaxons, but it is definitely a risk scenario that people are contemplating.
Are you worried, John? That's what
I think that there's
what do you think? Yeah.
The thing that concerns when Brendan and I talk about, we're focused on the way that financial markets are, beholden to Fed to Fed policy in such an incredible way. Yeah. And when you have a situation in which the sort of high flying parts of the financial markets, the Cathie Woods, the ARK, all that.
Yeah,
the super.
This week has been a bloody week for growth tech stocks.
Yeah, the super bubbly and exciting parts of the market. If those are being inflated by Fed policy, then policy and putting it in reverse obviously takes the wind out of those sails. Those have been coming down a lot, but you can have this sort of anti-reflationary impulse in financial markets feed through into and be, negatively pro-cyclical if the economy has some fundamentals, some fundamental flaws that we aren't really picking up right now. And you can have a situation in which the Fed is fighting last year's battle. In terms of inflation. And, the idea that we're going to get a lot of inflation numbers next week. The expectation is that the month-on-month pace is going to be coming down, but the headline numbers are still really, really high. And, the Fed is clearly, as you say, in rhetorical. Nobody's really sure how much of this really is rhetoric and behind the scenes, they're sort of ready to pivot back to a more balanced, later if this inflation impulse really does turn out to be transitory. But it's a very challenging kind of circumstance. I think the first quarter is going to feature elevated volatility because of this uncertainty and because of this push-pull and the sort of internal contradictions in the Fed's tightening cycle and what's perhaps transpiring in the real economy.
I think that's all there is to say on this, isn't there? I mean, this is like we're in a holding until we get those inflation more clues on the inflation numbers. Like this is a steady state, isn't it?
I think you're right. Yeah.
Yeah. I mean, right now the odds are the Fed hikes in March. And so in the last show, my bet was that the Fed hikes once, and my bet is they hike in March and not again. And their March hike looks like one of those repent.
I think if I remember it, I'll restate it here so we could keep accounting. I think I said 2, like they would do 1, then do another one to confirm it. But they'll stop after 2, and you're saying stop after 1.
Yeah,
well, it always shocks me. I mean, we do all this QE, and then the markets go up, and you're like, oh, it's not because of the Fed, but it really is because of the Fed. And then on the flip side, when we start to hike, the policymakers become shocked again that markets react negatively to the withdrawal of massive amount of stimulus.
Right. Yeah. If the Fed hikes in March and the S&P 500 is down 5 to 10% and then goes down another 5%, they're not hiking again.
But John, if you had, or what you're hearing from market participants that you're talking to, I mean, is anybody saying, look, I'm worried about equity markets this year? Like the way, as I look at 2022, I could see us finishing flat to negative in 2022. Is that what, are people expecting that, or are they expecting that because they're baking in that the either Omicron is going to be, or COVID is going to be worse than it is, or that the Fed is going to overreact? Or are they saying what you're essentially saying, which is Fed's going to do a little bit, get spooked, and then keep spiking the punch bowl for the rest of 2022, and equity markets should be fine?
Yeah, I mean, the baseline expectation is that the easy money has been made over the last couple of years in this like astounding rally. And when
that's the important thing to keep in mind for 2022. We've done so well the last 3 years that even people had lower expectations for 20-30% returns because we've done that for the last 3 years.
Yeah. And the idea is that the equity market does relatively well, but you've really got to pick your spots. And,
yes,
and the
exactly.
sort of danger zone of these like high flying tech stocks with no earnings. With no profits that have really led the charge to the upside. Those are buyer beware at this point. But it's an idea in which it really does follow your sort of formulation, Tony. And it speaks to your question as well, Matt, the idea that, if we do have the first quarter is when we've got all these clouds of uncertainty, inflation's still high. We've got Omicron, we've got, China slowdown, we've got, question marks about a fiscal drag and so forth. And we've got the Fed embarking on a tightening cycle. It's, anticipation is always scarier than the reality. And, but ultimately, if you flash forward to the summer, we could have, alongside our baseball season, knock on wood, we could have declining inflation rates, steady growth rates, the Fed turning more balanced. And that's a very pleasant kind of environment for volatility to come down, markets to stabilize and find their footing in the back half of the year.
I think that the general consensus was that 2022 was going to be a more difficult year for returns, and it could be a bad year if the Fed over tightens. With all that positioning, you could actually end up having a very good year for equities in the second half if the Fed hikes once, gets scared, and stops.
Yeah. Otherwise, it's just a stock picker's market.
Yeah, or if they're hiking right now. I mean, the Fed hiking rates isn't a problem if they're hiking rates not to fight inflation,
right? Exactly,
because the economy is so darn good in the second half of the year. If they put rate hikes in the second half of the year, and it's not necessarily to like tamp down inflation, but just because things are normalizing, then rate hikes aren't necessarily as terrifying.
Because usually rate hikes aren't bad for markets. They're actually they're fine, because usually the Fed is hiking because growth is very good. When you get worried is when the Fed stops hiking. But these are kind of unprecedented times.
Yeah. When's the last time we saw the Fed hiking because they're in inflation fighting mode? I mean, it's like, I haven't even seen that in my career. Yeah. Right? It's totally novel. And so there's definitely, there isn't a full belief on Wall Street that they're going to keep, they're going to keep at this until inflation is back at 2%. It just doesn't seem credible.
Yeah, I think that's right. And look, I mean, all the arguments on this, they're all for today and the last 6 months. We're just going to learn exactly what, like the grades are going to come in over the next 6 months. How much of it is transitory, how much of it is supply chain, how much of it is fiscal and monetary support. I think we're just going to have a much better sense of it looking back 6 months from now on this. And that doesn't help people, who are trying to invest, or, if you're trading for the next 6 months or you're investing for a longer term, that's, you're going to have to make your own judgments on that. But for commentators, we're going to learn that over the next period.
No, I feel on the inflation front, we're doing bad analysis. We're doing traditional analysis on it, where what we should be doing, if I was at the Fed, I would be breaking it down into the smallest pieces, finding out what's really up. Beef is up a lot. I would be on the phone to Nebraska to find out what the supply of beef is looking at, so that I can accurately predict in the next 6 to 12 months what if the price of steak is still going to be up 100% or it's going to come down. Same with car prices and things like that. Break it down to its smallest pieces, find an expert on those pieces, and I think you'll be able to get a good sense of the future of inflation.
The New York Fed just came out earlier this week with their supply chain pressure gauge, brand new gauge. It's a metric that includes a lot of different 27 different metrics and 27 or like a large number of different indicators. It's a really interesting thing. We're gonna have a supply chain expert break that down for us in our Sunday piece in Market Viewpoints. Maybe we can invite him onto our show next week to go through it. But the New York Fed is trying to do something like what Brendan is saying, and the conclusion that they put out on their Liberty blog was supply chain pressures appear to be easing, and the trend is in the right direction. And so I think that there is, and when you look at, when you can hear these kind of assessments bubbling up from the Fed, from Fed staff, that paper last year that came out that basically said inflation expectations are a red herring and don't really have anything to do with actual inflation. Is that voice from the staff level saying, hey guys, it's still transitory, or don't get too far over your skis in the tightening cycle. It's a very interesting thing to be following, and I want to dive into that maybe next week. If you
can get him on, let's get him on. It would be fun. All right, guys. Great Jobs Day show. Stay safe out there with the various snowstorms hitting the Mid-Atlantic region.
And rest up. It's a big week next week. We've got US CPI, US PPI, retail sales, industrial production, and the kickoff of first quarter earnings season. The big banks start reporting on Friday.
Oh, that's right. The banks start reporting. That'll be fun. And
we've got Fed Chair Powell and the deputy vice chair nominee Lael Brainerd in their confirmation hearings. So we ought to get some additional insight on Fed thinking next week too. So it's a pretty big week.
It's a jam-packed week, action-packed week in the macro land. All right, guys, have a great weekend. We'll catch you next week on the Macrocast.
Thank you for listening to the HPS Macrocast. Please remember to subscribe, rate, and share.